This is a BC Eagle Finance video. Feedback on Brigham & Young Chapter 3 Financial Statements. These questions come from the AST multiple choice questions that you have in Cengage. First item is question number 4. The income statement is designed to show how much money a firm has made or lost, or to put it another way, income earned or loss incurred during some past period. Various periods, including years or quarters or months, can be examined. In this question, the text uses the term money very loosely. In this question, money does not mean cash, but net income. In which case, this statement is true. The income statement is designed to show how much a firm has earned or lost during a particular period. What you have to watch out for is the term money. The text uses the money or the word money sometimes to mean cash and sometimes to mean income. If you ever have a question on the meaning, please don't hesitate to put up a discussion note on Canvas or to contact me. Item number 5. Accountants recognize that balance sheets are more meaningful if assets are shown in the statements at their current market values rather than their historical costs, which might be higher or lower than the amount that they would bring if they were sold today. Therefore, today balance sheets show assets at market values rather than historical costs, which would be the cost of purchase less any depreciation in the case of fixed assets, plant, property, and equipment. For those of you that have had upper-level accounting courses, this is a tough question because balance sheets today really show both. Here's the lowdown. For the most part, the balance sheet shows what assets cost less any accumulated depreciation. Those are for operating assets that are physical assets. On the other hand, more and more, balance sheets are showing financial assets, like investments, at their fair value. So balance sheets today will show both. How do you answer this question? Let's make a stipulation. Until we get to the point where we are examining financial assets, investments, let's assume that balance sheets are talking about plant, property, and equipment which are shown at their cost less accumulated depreciation. Up until then, let's ignore the fair market value for financial assets. Item 8. If a company's statement of stockholders' equity shows $10 million retained earnings, then the company could certainly afford to pay $10 million in cash dividends to its stockholders. Thing to keep in mind, retained earnings is not the same thing as cash. Retained earnings just earmarks how much all of the assets a corporation has that would be available or that could be made available to pay the shareholders. The company can only make that payment, however, if it has cash in its bank accounts. So, in the answer to this question, a company can only afford to pay dividends in the amount of cash it has on its balance sheet. That cash balance could be bigger or smaller than the amount of retained earnings. Retained earnings represents the amount of net resources that the shareholders can claim. Cash represents the amount of checks that the company can actually write to the shareholders. Think of it like this. If I had 10 water bottles and stuck them in a freezer for a couple of days, they would be frozen solid. If I wanted a drink, well, there are 10 frozen water bottles in the freezer, but I couldn't drink them because, well, they have not yet been turned into their liquid state. You can think of that as retained earnings. The frozen water is on reserve for the owner to use, but until a bottle is taken out and thawed, i.e. turned into cash that can flow, dividends, or that quenching drink cannot be taken. Item 11. Accountants recognize that balance sheets are more meaningful if assets are shown in the statements at their current market values rather than their historical costs, which might be higher or lower than the amount they would bring if they were sold today. Therefore, today, balance sheets show assets at market values rather than historical costs. This is a repeat of an earlier one, and it's worth repeating here again. Balance sheets do show both. Operating assets like plant, property, and equipment are shown at cost less accumulated depreciation, but financial assets like investments in stocks and bonds, more and more are shown at their fair market value. Until the book or your teacher tells you that we are looking at investments, conclude that the balance sheets show operating assets, plant, property, and equipment at historical cost, less accumulated depreciation. Item 13. Prior to the year 2000, different companies often used different accounting procedures, and as a result, two identical firms might show significantly different incomes. Similarly, different depreciation methods, inventory procedures, and the like could lead to different balance sheets, even though the two firms had exactly the same physical assets. However, changes in accounting procedures that took effect this year, that could be 2018, eliminated the possibility of such sanctions, and now, meaning 2018, financial statements are prepared consistently across all companies. The point of this question is to show that the FASB continually pumps out new accounting rules every year. There will always be legal options that the company can choose from to report different items of inventory, assets, and other items on the balance sheet. So the takeaway point is, even though the assets are exactly the same, the options of accounting that are available for companies to choose from can allow them to show those assets at different amounts on the balance sheet and could allow them to show income from those assets at different amounts on the income statement. So financial statements across companies will not always be comparable. When that happens, financial analysts make their own adjustments to the balance sheet to try to make the two companies that they're trying to compare as comparable as possible. Item 17. All of the items shown on the balance sheet are stated in dollar terms, but only cash and cash equivalents indicate how much actual money, in this case, the text uses money to mean cash, the firm has and can spend immediately without taking some other action like selling assets or borrowing funds. This is true, and the takeaway point is the company can only make checks in the amount of its cash account or cash equivalents. Item 21. If a company's statement of stockholders' equity shows $10 million in retained earnings, then the company certainly could afford to pay $10 million in cash dividends to its stockholders. This is a repeat of an earlier question. Retained earnings are not cash. The company can only pay dividends if its cash balance is big enough. The cash balance may be more or less than the amount of retained earnings. Retained earnings is a reserve. Cash represents the amount a company can spend. And item 23, is the following statement true or false? Net operating profit after tax, acronym NOPAT, is defined as NOPAT equal EBIT, earnings before interest and taxes, times 1 minus the tax rate. This is true. The purpose of NOPAT is to isolate the after-tax profit that the assets themselves generate before considering any costs of financing those assets. One major distinction that finance types make is the distinction between running the assets, using them and making profit from the assets, and financing the assets. So this NOPAT number that's created by financial analysts isolates the amount of income after tax that assets generate before financial considerations. That brings us to the end of the feedback. If you have any questions on this video or anything else from Chapter 3, please start a Canvas discussion or contact me. Thank you for listening.